Hi, I'm your host, Matt Jones, and I would like to welcome you to another episode of the Real Estate Roadmap podcast. Today, we're going to be talking about the BRRRR strategy. It's one of the most popular ways to invest in real estate and has really gained in popularity the last 5+ years since it gained the nickname or the acronym BRRRR. The BRRRR stands for buy. The first R is for renovate or rehab. The second R is for rent. The third R is for refinance, and the final R is for repeat because it's something you can do over and over again. So that's what it is. But what's important is how you actually do it. So, how do you go through the steps of the BRRRR process at a high level? How do you operate and execute this strategy to its fullest potential? And that's what we're going to jump into today. That's what we're going to jump into today. I thank you for joining me, and I'm excited to get started with you. Before we dive into the strategy itself, I want to take just a minute to talk about the positives and the negatives of the BRRRR strategy. Some people use the BRRRR strategy like a cure-all. They think it works for everything, which means they really don't totally understand it. So I want to talk about what it is and what it's not. First, the BRRRR strategy for me has been just a huge springboard. I started with a $70,000 home equity line of credit that I was able to obtain because I'd added some value to a house hack. And I've been able to use the BRRRR strategy mostly to keep reusing my money, adding to it a little as I can, but to keep reusing my money to be up to 26 rental units now. So the best thing about the BRRRR strategy is it allows you to reuse your investment capital. For people who want to grow, for investors who want to grow a pretty decent sized portfolio, real estate can really eat up capital. No matter how much money you have, down payments, renovations, they will go through it pretty quickly. If you don't have a way to replenish that money at a pretty quick clip, or you're not able to find a way to reuse your money. Now, if you can find no or low down payment deals, that would kind of work as a multiplier with the BRRRR strategy to really let you accelerate your growth as far as your real estate portfolio. But for most people buying with low or no down payment, those deals are harder to find than a deal that'll work for the BRRRR strategy. So that's why the BRRRR strategy is so popular, is because not only is it powerful, it's accessible, it's doable, and it's doable over and over and over. Now, I don't want to oversell the BRRRR strategy. In fact, I think that's probably already been done. So we're going to cover the negatives of the BRRRR strategy before we jump into the positives. So the first knock on the BRRRR strategy, if you will, is that in a seller's market like we've been in for the past several years, it's harder to find deals that work with the BRRRR strategy. And the first B is buy, and you have to buy right for it to work. So number one is it's maybe not as easy to execute in all markets. The second potential negative of the BRRRR strategy is that it takes some time. Right, you're going to buy the property, but since it includes a renovation, and renovations tend to go over your time limit and over budget, the time that a BRRRR strategy deal takes is working against you in a negative or in a rising interest rate environment like the one we've been in for the past 18 months or so. So if rates are going up, you may have penciled out that this is a fantastic deal and you're super excited about it at 6%. And by the time you finish the renovation, interest rates for that refinance part of the BRRRR strategy are at 8%, and your numbers look completely different. So in a rising interest rate environment, it's harder to do. It's harder to do the BRRRR strategy. It can make your existing deals worse, but probably the one way to get around that is to just make sure you're giving yourself a little bit more margin, which I think is a good tip. Period. Don't work. Real estate's hard. Don't work for free. Basically, make sure that you're going to make some profit. Don't just do deals to do deals, because you could work for a year only to break even or worse. So make sure that you're doing good deals. The third potential negative of the BRRRR strategy is it takes time. So if you are somebody who wants to put in some sweat equity, or who has time and wants to leverage that time to do better real estate deals and make more money, great. If you're somebody that has a busy career, a busy family, whatever it might be, you just don't have the time, it can be tough to navigate the BRRRR strategy. On top of that, your time commitment is not totally up to you. You're in charge, but the people working with you, your team, your contractors, your property manager, your lender, their performance is really going to impact how this deal works for you and how much time is needed. So the time that is needed might not be at a time convenient for you, or it's just not totally within your control. So the amount of time that a BRRRR strategy deal takes or can take certainly can be a negative for most people. And that's personal time. That's your time working in the deal. So that's the third negative. Now let's jump into what each letter stands for and how to execute on the strategy at each step at a high level. The B in BRRRR strategy stands for buy, obviously, but that doesn't tell the whole story. You must buy a good deal. You've got to get a good deal for the BRRRR strategy to work. So buy, but buy at the right price. Now, I've reviewed how to run your numbers in previous videos, so I won't belabor the point here. But I do want to take a moment, as always, to point out that it's important you run your numbers on the front end and that you're honest with yourself about the numbers. Again, we want to do deals that make money, that grow our wealth, and that are worth our time. We're not just here to work. We want to work with a purpose. So buy a good deal, run your numbers on the front end so that you're set up for success in the B portion of BRRRR. Now, while it's possible to find something that works as a BRRRR deal that's turnkey, it's pretty unlikely. In fact, one of the letters stands for Renovate. So if you think about it, the strategy is not even made for that. So BRRRR deals are by nature value add deals, meaning that they need some work, or maybe the property is in good shape, but you need to make changes like adding a bedroom or bathroom. So when you're looking for a BRRRR strategy deal, you're looking for a value add deal. I'll take a moment here to point out that if you don't have the ability, the budget, the interest, or the time to take on a value add property, there's a chance the BRRRR strategy is not for you. You really need to ask yourself, is the BRRRR strategy the best strategy for you, given your knowledge, your time, your financial constraints? The BRRRR strategy is powerful. In fact, to most people, it sounds too good to be true almost. So it's a great strategy, but it's not a strategy for anybody, or not a strategy for everybody. And that's true for basically any real estate investing strategy. If you go back and watch early episodes of this series, we talk about investing to your own goals. You've got to establish your goals before you start, or you're not going to know whether or not the BRRRR strategy or house hacking or one of 200 other different strategies is the right fit for you. So we're going to cover the next 4 R's and really get into kind of the meat and potatoes here of the BRRRR strategy. And as we're doing that, think, is this the best strategy for me, or do I just like the way it sounds? Can I actually execute on this in real life? If you can, great. We're going to give you the steps. If you can't, that's okay. There's a lot of strategies and a lot of them work. So just figure out and be honest with yourself on which strategy is best for you. The first R in the strategy stands for rehab. This is where you add value to the property. So think about what you would be comfortable with and start there, because there are a lot of different levels to adding value to a property. There are a lot of different levels of renovations. My first renovation was on a 104-year-old house that had been owned by hoarders and had been sitting vacant for 12 years. And, I learned that probably wasn't the best first real renovation. I had very minimal experience before that. And while I learned a ton doing that deal, and I did squeak out a profit, it took up so much time. It caused me so much stress, and that just wasn't necessary. And, thankfully I was in a season of my life where I was able to dedicate the time and make it work. But, it could have been catastrophic in a different situation. Had the market gone down, had interest rates risen, had one of so many different things happen instead of it going the way it went, it could have been a horrible deal. So not just because maybe you could figure it out doesn't mean that you should. Um, there are, everything from light cosmetic renovations to foundation issues and termites and fire. So I want to take just a second and break down, for most investors that don't have a good construction background, maybe the things you should consider and the ones that you should stay away from until you're a little bit more seasoned. If you can find something that's in relatively good condition, but it's really dated, dated to the point that most people would not just move in and live there, that can be a really good place to start for somebody that doesn't have a ton of renovation experience or a ton of investing experience. Kind of the next step up from that might be with something that has a little bit more deferred maintenance. It hasn't been cared for well. It's got a mix of needs repairs and also chances for cosmetic updating, updating the cabinets and countertops and painting and all that good stuff, flooring. Um, if that still sounds pretty simple, you're still totally in your comfort zone there. You can look at opening walls, converting existing space into a different living space. Maybe there's the 104-year-old house I did, it had a fully enclosed back laundry room. So we relocated that laundry room to a closet on the other side of the house where we were able to just make it fit. And we turned that laundry room, which was a pretty reasonable size, into a master bath. So we went from a 3-1 to a 3-2. That was a big value add. If you can add a bedroom or bathroom, but you can do it under the existing, roof of the home without having to do a full add-on, that's not nearly as complicated. It's a lot more accessible for somebody who doesn't have a ton of experience and knowledge. So that's a great place to start. Add-ons, full-blown add-ons come after that. There you could kind of work with a turnkey provider if you're going to add a new roof and a new slab or a new foundation to add onto the house. First, make sure you're adding on some really valuable space because it's not inexpensive to do an add-on. So you couldn't add on fairly insignificant spaces. You need to adding on a master bedroom, bathroom, maybe a kitchen. But an add-on, you're generally working with kind of a general contractor. If you do a good job hiring that contractor, then an add-on is not too scary. There are a few items, and I already mentioned them briefly, that I advise newer or less experienced investors to stay away from. One is significant termite damage. If you're down here in the Florida Panhandle where I am, then termites are just kind of a part of life, and you may have some damage, and that's not a big deal. But if they're eating into beams, if it's widespread, it's really, really hard to know the extent of the damage until you fully open up the walls. And most sellers are not going to let you do that until you own the property. So if you own it, you open up the walls and they've eaten through your main support beam in your roof or in your your main floor joist, that kind of thing. It's yours. It's your problem. So that's a pretty risky one to start with. The second would be foundation repairs. Foundation repairs are not as scary as they might seem, in my opinion. But at the same time, kind of like termites, you don't know what you get into until you start fixing it. They can break your plumbing lines. You could find more issues. So until you're a little bit more seasoned, be careful considering foundation. And the last one is fire damage. And I probably know more investors that fire damage scares off than the first two. You can have anything from a small, grease fire in the kitchen that just kind of smoked the place up to a fire that, impacted the structural soundness of the property and burn up the roof and all sorts of things. So a really light kind of smoke fire, okay, whether or not you want to take on is up to you. You need to do some more due diligence there. You need to figure out what the remediation is. It's not as simple as it might look, but a big time fire is a lot more complicated than it looks. So on those three items in particular, really be sure that you're comfortable before you jump in and take on a renovation or rehab that includes one or all three of those items. Okay, if you're still with me, we're on to the second R, in the BRRRR process, and that is rent. Now, rent's not the most complicated part of the deal for sure, but rent is very important. Okay, if you're hiring a property manager, you should have already interviewed them and know who you're going to hire before you finish your rehab. As I talked about in an earlier part of this video, time is not necessarily on your side. So don't waste time by getting to the rent process and then just starting. By the time you're to the rent process, you should know who you're going to hire as a property manager. If you're going to hire a property manager, you should know how much you're going to charge for rent. You should have lined up. I always do professional photos. One, it's great to market and get top dollar for the rental. Two, it looks good, just to kind of have in my portfolio. I can have before and after pictures. That way, when I'm talking to somebody, whether it be a bank or a potential partner, I can say, look, here's evidence of the work I've done before. You can see I turned this junk heap into this really nice property, and here's the budget I did it on. So those things should already be in line. A couple other things that are maybe a little bit easier to miss. Make sure you have full coverage insurance. It's not uncommon to have just been working on kind of a builder's risk policy while the property was vacant and you were doing your renovation. You're going to need a full coverage type policy generally by the time you get to refinancing anyway. But by the time you start to have anybody living there, moving in, that kind of thing, you want to have all your bases covered, not just a builder's risk policy. Two, and I really hate that I have to point this one out, but get the unit in tip-top shape. So many investors, and believe me, I get it, but they have this, by the time they get to the end of a project, they're really fatigued with the renovation process. Renovations usually go over budget. They usually go over time frame. If you're not really experienced and haven't done a bunch of them, they can go way over budget and way over time frame. So you get near the end and you just kind of say, close enough. Okay, that's not done, that's not perfect, but the big picture's done. It looks so much better than when I started. But here's the deal. Just take it to the finish line. You're almost there. Usually you're just talking about a couple days worth of punch list work, getting it cleaned really well. You're going to attract better tenants. You're going to get more money for it. It's going to photograph better. It's worth it. So don't let renovation fatigue kick you in the butt at the end and keep you from turning your project into a fully finished, the realization of that idea that you had when you started. The last thing I'll say under rent, in my experience, your lender is going to want to see a long-term lease. So I definitely would not recommend doing a verbal lease, which I never do personally, and I wouldn't recommend doing a month-to-month lease. I would sign somebody on to a 12-month lease, and at a good rate, because however much income it brings in may impact your ability to get a loan, or at least to get a loan at the amount and terms that you want. So hold out. If you think the place is worth $1,500 a month, don't rent it for $13 because you're tired of having it sit vacant after only a week. Do what you need to do. Don't be unrealistic, but do what you need to do to get the right market rental price for it, and sign a long-term lease with that tenant. The third R in the BRRRR strategy is to refinance. This, for a lot of people, is the most important part. I kind of say it's one of the key parts. By pulling your cash back out of the deal, you're able to go do the next deal. You're able to keep investing. If you successfully pull your money out every time and you keep doing BRRRRs, then theoretically you could start with with your pile of money here, and you can just keep reusing it. If you don't have the ability to add to it, it's okay. You're able to keep doing deals. To be candid here, not every deal is going to let you pull 100% of your investment back out. But say that you had $50,000 invested and you're able to pull 35 back out and you have to leave 15 in. Well, your cash on cash return on that 15 is probably much better than it would have been on the 50, for one, but also you have $35,000 to go do another deal. So the financing is very important. Also, the terms of your financing are really important. I'm not sure that all investors understand that. They just get the first loan that they can get approved for, and sometimes they leave too much money in the deal, or they don't secure good long-term financing. They get the wrong type of financing. Personally, I'll be honest, I didn't really understand the value of long-term financing. When I started investing, I was really pretty new. I started it with my previous career, but when I really got into doing deals, I was a new real estate agent. I couldn't go out and get a 30-year conventional loan. I just wasn't going to qualify for that. So I was using commercial loans with 5-year 5-year term and a balloon at the end of the 5 years, which has never been a problem. I can always refinance it, or have always been able to refinance it. But the interest rate, when you refinance it, you're going to be looking at a new interest rate. Well, interest rate environment was pretty stable. Um, the loan type I could qualify for, the rates weren't too bad. They were allowing me to pull most of my money back out. So I just kind of kept using them even after I was established as an agent, and I could have gotten different kinds of loans. So now, anything that comes up for refinance, I'm looking at a significantly higher rate than I had 5 years ago when I started that loan. And, that's something at the time that I just didn't give enough respect to how important the terms were and the long-term financing was. Back then I hadn't heard of a DSCR loan either. I imagined that they existed, but I sure hadn't heard of them. I really hadn't heard of them until the last few years, and they're only now gaining serious popularity. So that's a loan that also, as a new agent, I wouldn't have had to qualify for personally. It would have been on the property, and if the property made enough money, then it could qualify. But those are 30-year loans. So go back and watch my 2 videos. I have one on conventional loan options, one on investment loan options. But it's really important at the refinance step to take your time and make sure you're using the right loan for you and for your situation. It will help you big time in the long run. Now, the final R in the BRRRR process is simply to repeat. You've done it once, you've pulled your money back out, or at least most of it. It's time to go do it again. Go find the next deal and do it over and over. And that's what's so magical about the BRRRR process, is that you can do it over and over. As long as you can find a deal and you're willing to put the time into the rehab, rent, refinance, you can always repeat. So the BRRRR strategy is not for everyone, but for the people who it is for, it's incredibly powerful. You can combine it with other things to really make it go. And it's been one of the core foundations of my real estate success as far as investing goes. Thanks for joining me. Be sure and hit that like and subscribe button for more great real estate content if you enjoyed this, and I hope that you'll join me on my next episode.